Imagine scoring a 99% on a really grueling final exam.
Right, yeah.
And the only thing anyone wants to talk about is that tiny 1% you miss.
It's wild, but it happens.
It does, and that is exactly what Wall Street is doing right now to F.N.B. Corporation's Q1 2026 earnings. So, okay, let's unpack this because we are jumping straight into their earnings release today.
And their investor slide deck, too.
Right, the slide deck plus the quarter conference call transcript from April 17th. Our mission for you today on this custom-tailored deep dive is to, well, cut through all that incredibly dense banking jargon.
There's definitely a lot of it in there.
Oh, absolutely. We want to extract what is fundamentally a masterclass in modern risk management. And I have to say, the visual you've got going on behind you today, that massive, bustling cityscape skyline, is just the absolute perfect metaphor for the commercial real estate puzzle we are about to dissect.
Well, the cityscape is entirely intentional. I mean, we are looking at a regional bank navigating macroeconomic waters that have, capsized, less disciplined institutions over the last few years.
Yeah, looking out the window, you just see pure macroeconomic panic regarding regional banks right now.
Exactly.
Yeah.
But to understand how F.N.B. is operating, we really have to bypass the market's initial emotional reaction and examine the structural philosophy that's holding up their balance sheet.
Which is funny because F.N.B. appears to be pulling off a magic trick. The top-line scorecard paints this really conflicting picture of market expectations versus actual performance. Let's establish that financial baseline first.
Sure. So what's fascinating here is the disconnect between the raw operational numbers and the narrative. If we pull the actual figures, F.N.B. posted a net income of $137 million for the quarter.
Okay.
The earnings per share, the EPS, hit 0.38 cents, which matched consensus estimates and actually represents a 19% growth year over year.
Which is fantastic.
It is. But then you hit the revenue line, which was $450.26 million. And Wall Street, well, they expected $454.06 million.
A $3.8 million miss.
Yeah.
On a base of nearly $500 million in quarterly revenue. I mean, to me, that is a rounding error. It's a statistical blip.
It really is, logically speaking.
But financial markets are incredibly reactive, right? And algorithms often trade strictly on these headline misses.
They do. They reacted to the top-line miss. But F.N.B.'s management issued a massive, deliberate counter-signal right there in the exact same report.
Oh, the buybacks.
Exactly. They authorized a brand new $250 million stock buyback program.
Wow.
Which brings their total repurchase capacity up to $300 million. And simultaneously, they bumped their quarterly dividend by 8% to $0.13 per share.
I have to challenge the logic of the market's reaction then. I mean, why flag a relatively tiny revenue dip when a 19% EPS growth and this heavy capital return are sitting right there in plain text?
Because capital return is the ultimate lie detector test for a bank's internal health. A management team just doesn't flush $300 million out of their capital reserves if they're genuinely terrified about a $3.8 million revenue miss.
Or some impending economic collapse.
Right. If there were real structural cracks in their lending engine, regulatory pressure and basic self-preservation would force them to hoard every single cent.
Just to build a capital fortress.
Exactly.
So by authorizing those buybacks, they are mathematically stating that their own shares are undervalued and that buying them is the best possible investment they can make.
They are basically forcing the market to look at their internal confidence. By reducing the number of outstanding shares through buybacks, they consolidate the value for the remaining investors.
Which artificially boosts future earnings per share.
Spot on. It completely overrides the slight top-line dip. It is an aggressive, definitive show of strength.
But, executive swagger has to be grounded in reality. You cannot bluff a dividend increase during a regional banking squeeze.
No, you definitely can't.
The underlying assets have to generate the cash to pay for it. Which means we really need to look at who they are actually lending money to and how safe those loans are.
The balance sheet is where the truth lives. So total loans grew 3.9% annualized, hitting $35.1 billion.
That's a solid number.
It is. But the composition of that portfolio is what really matters. It's 60% commercial and 40% consumer. On that consumer side, they're operating in the prime and super prime tiers.
Which means very good credit.
Yeah. Over the last 12 months, the average FICO score of their consumer borrowers was 782.
Wait, a 782 average FICO score, that is exceptional.
It's extremely high.
That means those are highly reliable borrowers who prioritize paying their mortgages and auto loans above almost everything else.
Absolutely.
But the consumer side isn't really what keeps Wall Street analysts awake at night right now. It's the 60% commercial side, specifically non-owner occupied commercial real estate, that is the current boogeyman.
Oh, the CRE boogeyman, definitely.
And F.N.B has 24% of its entire portfolio sitting in that exact category.
Yeah, and if we connect this to the bigger picture, the phrase non-owner occupied basically means developers and landlords holding properties where third-party tenants pay the rent.
Like huge office buildings.
Right. And the regional banking sector has been brutally punished recently because less disciplined banks finance these monolithic, multi-hundred-million-dollar downtown skyscrapers.
Oh, yeah.
So when remote work emptied those buildings and interest rates spiked, those massive concentrated loans just turned toxic simultaneously.
It's the classic fatal flaw of making a single, terrifying bet at the roulette table. If the anchor tenant of a 60-story glass tower breaks their lease, the landlord defaults, and the bank takes a catastrophic hit.
Precisely. But F.N.B seems to treat their commercial portfolio more like a highly diversified mutual fund.
How so?
Well, the internal data validates that strategy. Their average office loan size is just $1.6 million.
Just 1.6.
Yeah, they are practicing hypergranularity. Instead of holding the note on $160 million tower in a single major city, they hold $1.6 million properties spread across multiple different markets.
Wow, okay. A $1.6 million commercial property isn't a skyscraper. That is like a suburban medical plaza or maybe a local accounting firm's standalone office.
Exactly. So a single vacancy or default in a $1.6 million property doesn't trigger a systemic crisis. It barely registers on the balance sheet.
Right.
This philosophy actively insulates them from the macroeconomic shocks that are taking down their competitors.
And that granular strategy clearly shows up in their asset quality metrics. But I want to make sure we actually understand the mechanism behind the accounting here for you listening.
Sure.
Because we see net charge-offs at just 18 basis points or 0.18%, and the provision for credit losses is $18.5 million. How do those two metrics interact to tell us the health of the bank?
That's a great question. Think of the provision for credit losses as the bank's proactive rainy day fund.
Okay.
It's an expense they take out of their current earnings today to cover loans they mathematically suspect might go bad tomorrow based on economic models.
And they're setting it aside just in case.
Right. Net charge-offs, on the other hand, represent the actual realized losses, the loans they have officially deemed uncollectible and have already written off the books.
Ah, I see. So an $18.5 million provision is relatively modest against a $35 billion portfolio.
Very modest.
Meaning their forecast for future pain is low, and an incredibly low 0.18% charge-off rate means their actual realized pain today is practically non-existent.
Exactly. And delinquency across the board is sitting at just 0.74%.
Wow.
Yeah, the granularity naturally dilutes their exposure. They've basically engineered a loan book designed to bend rather than break under pressure.
But, you cannot fund $35.1 billion in highly disciplined loans out of thin air.
No, you need cash.
You need a massive, stable pool of cash to lend against in the first place, which forces us to flip the balance sheet and look at deposits, and more importantly, the cost of keeping those deposits inside the bank.
Right, so total deposits grew 1.5% annualized to $38.4 billion.
Right.
And the composition of those deposits reveals a profound structural advantage.
What's the breakdown?
Currently, an astounding 26% of their entire deposit base consists of non-interest-bearing accounts.
Wait, really?
Yeah, that is roughly $9.8 billion. And just to give that historical context, back in 2009, that figure was only 16%.
Okay, here's where it gets really interesting. Just as a consumer observing the broader economy, right? The Federal Reserve has kept rates relatively high. You can easily find money market accounts or certificates of deposit yielding solid mid-single digits.
Oh, easily.
So why on earth are people leaving nearly $10 billion in checking accounts earning absolutely 0% interest?
It defies traditional academic economic logic, honestly. Economics assumes consumers act as perfectly rational yield chasers, moving money the second a better rate appears.
Right, they should be moving it to a 5% CD.
Exactly. But in reality, human behavior is driven by friction. This is a concept known in the industry as deposit stickiness.
Deposit stickiness,
Wondering
meaning money stays where it requires the least amount of effort to manage.
Exactly. And F.N.B. has aggressively invested in digital infrastructure to capitalize on that exact human tendency.
How so?
Well, they have an award-winning e-store, a common omni-channel application process, and a really seamless mobile interface.
Oh, I see.
So when your paycheck direct deposits there automatically, and your automated bill pay is perfectly calibrated, and your peer-to-peer transfers are flawless.
Yeah, the friction of unentangling your entire financial life just to chase a slightly higher yield on your daily operating cash becomes a massive deterrent.
You nailed it.
I mean, the headache of switching 30 auto payments and relinking your external accounts simply isn't worth the extra $50 a year. The technology literally engineers the stickiness.
It really does. And that engineered stickiness is the ultimate cheat code for a bank's net interest margin, or NIM.
Let's define that really quick.
Sure. The NIM is simply the spread between the yield a bank earns on the loans it issues and the interest it pays out to its depositors.
Okay, that makes sense.
So F.N.B.'s M edged down 3 basis points to 3.25%,
Yeah.
and the cost of their interest-bearing deposits dropped 13 basis points to 2.40%.
Got it.
And both of these metrics were heavily influenced by the Fed lowering its target rate back in December 2025.
But having $9.8 billion in zero-cost funding serves as a massive shock absorber, right? It artificially widens the spread because a full quarter of their raw material, their deposits, costs them absolutely nothing to hold.
Exactly. Maintaining that huge pool of free checking accounts stabilizes their earnings. It allows them to absorb fluctuations in the broader rate environment without crushing their operating margins.
Speaking of the broader rate environment, that leads us directly into F.N.B.'s forward-looking guidance for the rest of 2026.
Oh, this is a great part.
Because net interest margin is technically tethered to whatever the Federal Reserve decides to do with interest rates, right? But F.N.B.'s leadership made a strategic choice in this report that feels highly unusual.
The guidance playbook they are using is aggressive in its conservatism. They maintain their full-year net interest income guidance, projecting a range of $1.495 billion to $1.535 billion. But the critical detail here is that management completely stripped any assumed Fed rate cuts out of this projection. They essentially erased the Fed from their internal math.
So what does this all mean? I mean, Wall Street is intensely focused on when the next rate cut will happen.
Absolutely hyper-focused.
Right, so completely ignoring it in your public guidance feels like a gamble. Is management genuinely pessimistic about sticky inflation, or are they just playing defensive mind games with analysts?
This raises an important question about the psychology of corporate guidance and how executive teams manage external expectations.
Okay.
It is less about pessimism and more about asymmetric risk management. When a bank bakes 2 or 3 rate cuts into its guidance, it creates a really rigid dependency.
Because if they don't happen.
Exactly. If inflation stays hot and the Fed holds rates steady, the bank automatically misses its target. Analysts downgrade the stock and capitalization suffers.
They basically become hostages to the Federal Reserve's unpredictable calendar.
Yes. So by completely removing the rate cuts from the forecast, F.N.B. anchors Wall Street's expectations to the hardest possible path forward.
Setting a really low bar.
They are stating to the market, we will hit $1.5 billion in net interest income, even if the macroeconomic environment provides us with absolutely zero relief.
Wow. That is the ultimate under-promise and over-deliver strategy.
It really is.
It is like planning a massive cross-country road trip and building your time and gas budget, assuming you will hit every single red light and major traffic jam along the way.
That's a perfect analogy.
Mm.
Because if the Fed does ultimately decide to cut rates, which fundamentally lowers the bank's wholesale borrowing and deposit costs, it just becomes unmodeled upside.
It turns into found money.
Exactly. They have eliminated the downside risk of a hawkish Fed while preserving all the upside potential of a dovish one.
That's incredibly smart. But, while they wait out the Fed's decisions, F.N.B. isn't just sitting in a defensive crouch hoping for a green light.
No, not at all.
Yeah. The report shows a massive push to generate revenue entirely outside of traditional loan interest. Earning money on the spread is great, but they are aggressively hunting for alternative profit centers.
Right, and the transformation of their business model is super evident in the long-term data.
How far back are we looking?
Since 2009. They have grown their total revenue by a factor of 5, allowing them to return $2.4 billion to shareholders.
That's huge.
And a significant driver of that growth is a calculated expansion into fee-based services. They've built out 10 distinct business lines that operate as multi-million-dollar non-interest revenue generators.
So we are talking about divisions like wealth management, insurance, and trust services, right?
Exactly.
And they have seen a 9% compound annual growth rate in that non-interest income since 2015. Capital markets revenue alone has more than doubled in that same time frame.
Yeah, they have effectively diversified away from relying solely on interest rates for survival.
But transformation of that scale is incredibly expensive. I mean, you look at the flip side of the coin. Their 2026 non-interest expense guidance, and management nudged it to the high end of their range.
They did?
We are looking at a projected spend between $1 and $1.02 billion.
$1 billion in expenses represents a massive operational footprint, and the drivers behind that number reveal a lot about their strategic priorities.
What are they spending it on?
The earnings report explicitly cites heavy investments in technology and artificial intelligence, de novo expansion.
Which is the physical construction of new branch locations in strategic markets, right?
Correct. Plus, higher fraud losses, the financial impacts of their community uplift program.
And we absolutely have to mention my favorite line item in the entire earnings report.
I know exactly what you're going to say.
Unusually high snow removal costs driving up Q1 expenses.
It's funny, but it's true. The granular reality of physical operations occasionally disrupts the cleanest financial models.
It proves that no matter how sophisticated your predictive algorithms are, a multi-billion-dollar financial institution is still at the mercy of Mother Nature.
And a guy driving a snowplow.
Literally. It's like a homeowner meticulously balancing a spreadsheet budget, only to have a sudden leaky roof wipe out the entire month's savings in an afternoon.
Exactly.
You can model systemic financial risk, but you cannot model a blizzard.
You really can. The snow removal is a brilliant example of unavoidable physical risk. But the discretionary expenses, the AI, the technology, the physical de novo branches, that's where the real narrative lies.
Okay, let's dig into that.
A short-term investor might look at $1 billion in expenses and worry about margin compression. But those expenses are the exact architectural foundation required to support everything we've discussed so far.
Okay, let's trace that logic back, because without the heavy tech spend, the digital e-store becomes clunky.
Right, and the moment the digital experience becomes clunky, friction increases for the user.
Oh, I see where this is going.
When friction increases, that $9.8 billion in zero cost, sticky deposits suddenly starts looking for higher yields at competitor banks.
It all connects.
Furthermore, you do not achieve massive growth in wealth management or capital markets without deploying serious capital up front to build secure, high-speed trading platforms and hire top-tier industry talent.
So they are intentionally absorbing higher non-interest expenses today to future-proof the deposit base and build the fee-generating engines of tomorrow.
It is a calculated cost of long-term transformation. Wall Street often punishes heavy expense quarters, but in this context, it is capital deployed to widen their competitive moat.
We've covered a massive amount of ground here, traversing from stock buybacks all the way to snowplows.
We really have.
And the connective tissue through all of this source material is a definitive masterclass in conservative, calculated risk management. For you listening right now, whether you are running a household budget, trying to launch a startup, or walking into a massive corporate strategy meeting, F.N.B's playbook holds immense practical value.
The principles scale perfectly from personal finance to corporate governance.
Absolutely. First, diversify your risk exposures. Do not make a single massive bet on a shiny downtown skyscraper. Spread your exposure out like F.N.B's highly granular $1.6 million commercial loans, ensuring no single failure can take you down.
Right.
Second, engineer stickiness. Make your product or service so perfectly frictionless that your clients or your capital will not leave, even when the external environment changes.
That friction is everything.
And finally, plan your operational baseline, assuming the environment will give you absolutely zero help. Strip the hope out of your projections so any macroeconomic tailwinds turn into pure, unmodeled upside.
You know, before we wrap up, I want to connect two seemingly unrelated data points from the far corners of this earnings report for you to mull over.
Okay, hit me.
We discussed their heavy capital deployment into AI and data science to predict loan defaults and optimize consumer behavior.
Yeah.
We also discussed the unpredictable margin-eating physical risk of unusually high snow removal costs.
Right, Mother Nature striking back against the algorithms.
Exactly.
Yeah.
But for how long? I mean, if regional banks are increasingly transforming into agile technology companies, utilizing predictive AI to optimize every single dollar on their balance sheet.
Wait, are you saying
How long until a bank like F.N.B starts treating weather not as an unpredictable act of God, but as just another solvable data variable?
Applying machine learning to hyperlocal weather models.
Imagine them utilizing AI to perfectly predict those patterns, dynamically optimizing their physical risk exposures, and perfectly allocating their snowplow budgets with pinpoint efficiency.
Days before the first snowflake even hits a branch in Pennsylvania or Ohio.
Exactly. When you have that much historical data and that much processing power, the boundary between financial modeling and physical reality begins to blur.
Wow, that is a fascinating thought to leave on. Thank you for joining us on this custom-tailored deep dive into F&B Corporation. Keep questioning the numbers, look for the underlying mechanisms driving the spreadsheets, and we will catch you next time.